Dear all, I warmly welcome you to the presentation of the results for the first half of 2025. Having already published our order intake in advance as usual, I would now like to present the other key financial figures. Revenue, output, EBIT and liquidity. First, I will give you a concise overview. As reported, order intake increased by 29%. In addition, revenues also grew significantly, namely by 30% compared to the previous year. Output also increased by almost the same amount at 28%. This reflects the high production output of our plant. Earnings before interest and tax improved by as much as 39%. Without unfavorable currency effects, the increase would have been even more pronounced. Liquidity also developed particularly strongly. At mid-term, it was around 57% above the figures for summer 2024. The fact that it is down compared with the end of 2024 is explained by the fact that the advance payments available at the end of the year were converted into concrete sales in the current first half of the year. As usual, we look at sales development from two perspectives. The first is the breakdown by business segment. New machines, many CHP plants, supplemented by a few heat pumps, as well as service and spare parts. This chart also shows sales for the second half of the year. On Thursday, 4th of September, we announced a more specific estimate for the second half of the current year. At the beginning of the year, we had forecast an increase in sales from 376 million in 2024 to 430 to 450 million for 2025, an increase of 15 to 20%. However, the current situation made an adjustment necessary. Due to the pending EU approval for the so-called biomass package in Germany, part of the planned new business will not immediately contribute to revenues this year. Although numerous German biogas customers have already placed orders, they will not give production approval until late in the year. As a result, we are now limiting our revenue forecast to a maximum of 440 million euros. This corresponds to a growth of up to 17% instead of the previous 20%. The 10 million shortfall is not lost, but will be realized in 2026. At the same time, we are adjusting our EBIT expectations from up to 10.5% to up to 9.5%. Total sales rose by 30% in the first half of the year. Service sales increased solidly by 12%. New machines in particular saw strong growth of 55%. From a regional perspective, the strongest growth came from Europe, particularly Ukraine, which accounted for the lion's share of growth in the first half of the year. The German market also performed well, with new machines up to 5 million euros and service up to 3 million euros, resulting in overall growth of 10%. Sales in North and Central America rose by 16%, while the rest of the world lagged behind the previous year with around 10 million euros. The decline there is due to the project-specific structure of these markets. It is noteworthy, however, that service sales are also becoming increasingly established in these markets. Overall, growth in foreign markets amounted to 59%. The export ratio reached 49%, representing another significant increase compared with previous years. Let's have a look on the consolidated income statement. Total output reached a new record level of 193 million euros, representing an increase of 28%. Material costs rose by 31%, driven by the higher material intensity of machine sales. Consequently, the material ratio increased from 61.9% to 63.2%. Personnel expenses increased by 17%, but remained significantly below the overall output. As a result, the personnel cost ratio fell from 23.9% to 21.7%. Depreciation is increasing mainly due to the machinery we have been operating in Puerto Rico since the second half of 2024. Other operating expenses rose by 31%, mainly due to higher sales commissions, external R&D contributions, additional costs in connection with the ERP project, and higher travel expenses. In addition, there were negative currency effects instead of positive effects in the first half of 2024. Overall, the half year closed with EBIT of 5.7 million euros, representing an increase of 39% over the previous year. At 3.3%, the EBIT margin was slightly higher than last year. Let's look on the operating working capital. Operating working capital rose by 21% in the first half of the year, slightly less than the total output. Inventories in particular increased by 25 million euros. Of this, 23 million euros was attributable to nearly completed CHP units, all of which were manufactured to customers' order. Advance payments already received in the amount of around 12 million euros largely covered the increase of raw materials and supplies. These additional raw materials are necessary to prepare for the second half of the year. Once again, inventories increased 25 million euros. This is due to the increase in nearly completed CHP units, all of which were manufactured to customer orders. Trade receivables declined as a significant portion of deliveries, particularly to Ukraine, had already been paid for in full. Prepayments not related to orders also declined after reaching exceptionally high levels in December 2024. Trade payables increased by 15 million euros. This is attributable, on the one hand, to a normalization following the low figures at the end of 2024, and on the other hand, to pull forward effects in connection with the changeover to the new ERP system. Overall, it is clear that the increase in working capital is exclusively due to the significant increase in almost completed order-specific CHP units. This is, as such, a positive development. A few words on liquidity. Liquidity decreased as planned on the reporting date compared with the end of 2024, but was still 57% higher than at mid-year 2024. The decline is primarily due to the conversion of high advance payments received in December 2024 into revenues. At the same time, various investments were made. 1.4 million euros for the global ERP system, 1.2 million euros to expand the service vehicle fleet, 0.9 million euros for a new assembly hall with attached office building, and 0.2 million euros for other business and operating equipment. In the area of financing, financial liabilities amounting to 1.4 million euros were repaid. In addition, a dividend of 3.6 million was distributed in June. The negative cash flow from financing activities thus amounted to 4.7 million euros. This left liquidity of 14.2 million euros available at the end of the first half of the year. Let's discuss the outlook. We continue to anticipate a significant increase in revenues for the 2025 financial year, even though the planned upper limit of 450 million euros will be difficult to achieve due to the delay in EU approval for the German biomass package. Our updated forecast now puts revenues at between 430 million and 440 million euros. This level corresponds to growth of 15 to 70% compared to the previous year. This is slightly below the original expected range of up to 20%, but does not fundamentally jeopardize the growth course. Assuming a split between new machine sales and service of 55% to 45%, similar to previous years, we get this picture. It becomes clear that the current order backlog obviously secures the revenue forecast. Projects already commissioned are sufficient to reliably underpin the new targets of 430 to 440 million euros. The challenge lies not in demand, but in the regulatory delay caused by the EU approval, which slightly limits our commissioning and invoicing for 2025. However, these effects will have a positive impact on 2026, as the postponed orders will carry over into the coming financial year. The associated EBIT expectation has been adjusted accordingly from up to 10.5% to up to 9.5%. The mathematical midpoint of our forecast now represents a sales volume of around 435 million euros and an EBIT margin of around 9%. Of particular relevance here is that EBIT growth will continue to be in average well above 20% per annum. Our medium-term growth outlook remains attractive. For 2026, we confirm our forecast of revenues of up to 490 million euros with an EBIT margin in the range of 9 to 11%. Let me briefly talk about our new data center division. Why is it suddenly so promising? First, here is a recent study from this year. It says, as do several other serious studies, that a reliable power supply is the top factor for choosing a location for a data center. Even more important than connection to an internet node. Even more important than data protection. Without electricity, there can be no data center. In fourth place is the price of electricity. And in this context, reliable power supply means electricity that is available under all weather conditions and capable of handling baseload, and at attractive prices. However, as the public power supply in many industrialized countries is stretched to its limits, data centers will in future almost always need their own power supply, not just as an emergency solution, but in 24/7 mode. And that's where we come in, because we have been familiar with this 24/7 mode for decades. We have solutions which you can see here, namely a 1 megawatt module on the left side and the 2.5 megawatt module on the right side. The 1 megawatt module is characterized by the fact that it is stackable and therefore extremely compact, a real USP among other USPs. So, we have solutions that are attracting interest worldwide. We are involved in a number of tenders. These tenders are very, very lengthy. We therefore expect the first orders to come in next year. Please don't forget, we only really entered this business a few months ago. The data center segment is a real add-on to the frequently communicated growth path of 10% plus inflation. Thank you very much for your attention.